Hey, good morning, everyone. Welcome back to Paycheck the Portfolio. First off, I just wanted to say thank you. I just got back from Alaska with my family, and it was an incredible trip. We got to unplug 7 days on a cruise ship and spend time together. And honestly, that's what Paycheck the Portfolio is all about. We just recently crossed 23,000 subscribers, and I'm so humbled and thankful for each and every one of you, your comments, the questions, the Discord. So I just wanted to show gratitude and to say thank you for being part of the community. It means so much to me. Today, I wanted to talk about a topic that comes up all the time, specifically, how do you pay your bills without spending your paycheck? And what does that look like in the paycheck to portfolio system? This morning, I'm planning on walking you step by step through the exact system I use, showing you my real portfolio and giving you the updates. And then we'll go through these slides looking at the traditional method of investing versus the paycheck to portfolio method. I'm going to show you a simple balance sheet and how I basically run my portfolio like a business. And I'll give you an update this morning. So let's jump into a portfolio update now. Looking at my live numbers, you can see my net account value sitting at $205,861. My straight equity gain is sitting basically at $49,383 or 12.5%. Friday and Thursday was a good day in the market. It rebounded quite a bit with news going on in the Middle East as far as potential agreements. And then the SpaceX IPO came out Friday, which I think just infused some cash back into the market, especially the NASDAQ. But Friday, the portfolio was up $1,684. Looking at the historical values tab, over the last year, while fully living out of my brokerage account, the account has grown $80,000 while fully living out of the brokerage account. If you're new to my channel, all of my income comes into the brokerage, gets fully invested. I borrow from the equity to pay my bills at a lower interest rate. And so what I'm getting is I'm getting ownership in the form of assets. I'm borrowing from that equity at a lower interest rate, which allows me to stay fully invested in the stock market and to create dividends at a higher rate than what my margin interest rate costs me, which I'll show you on the slide deck here shortly. Over the last 2 years, the account's up $104,000. And over the last 3 years, it's up $164,000. If you think about a checking account in a traditional sense, when you bring your money and you deposit it into Capital One or Wells Fargo or whatever bank you want to discuss, obviously, they don't keep your money in a vault. They lend your money out to somebody else. They charge them a higher interest rate than they're paying you, and that is their entire business model. When you think about an escrow company, if you're paying your taxes and your insurance and your escrow account on your real estate, again, they're not keeping that money in a vault. They're investing that money and then they're borrowing from their equity to actually service what needs to be paid out, and that is their business model. And then when you think about wealthy people, they do the same thing, such as Elon Musk, the Waltons. We'll talk about that a little bit more as well. Looking at my estimated income tab, this ebbs and flows. Over the next 1 year, it's projected to be basically at $43,503. This was $49,000 last week. This ebbs and flows depending on the last distribution, annualized out over the next 12 months based off of what a lot of the covered call or high yield funds pay. On average, I'm anywhere between 40,000 and 60,000, depending on how the volatility is working in the market. And so basically what happens is I get the equity gain from the assets here, and then the dividends come behind that and layer on top of that. And that's what we refer to as total return. So my total return over the course of the last few years is over $120,000 when you layer those things together over the last several years. So it's important that you're looking at it in the right context. So I have a gross portfolio value that's over $400,000 and a net portfolio value that's over $200,000. I'm getting equity growth, dividends, and then over time that just accumulates more and more on top of itself. Let's look at the performance tab next. Looking at the 2-year performance, I started fully living out of my brokerage account in June of 2024. So this 2-year time frame is perfect for me because it picks up basically right in June, July of 2024 when I started fully living and fully investing out of my brokerage account. You can see on the time-weighted return, I'm sitting at 61.7%. The S&P 500's at 39%. The Nasdaq's at 51. The Dow's at 32, and the Russell's at 45. And then looking at the 3-year chart, in this chart, the Nasdaq and the indexes have a head start on me because I didn't fully live out of the account until June of 2024, right in this area, right in here. So this has a little bit of a head start on me. So over 3 years, I'm up 78.2%. The S&P 500's up 73%. The Nasdaq's 95. The Dow's 51. And the Russell's 58. So obviously, the stock market has been doing really, really well. And the longer you're in the market, the more money you're going to make over time, simply due to inflation in and of itself. Let's jump back into the slide deck and go step by step through the system. All right, this morning we're going to talk about the portfolio cash flow system. And when I say stop paying your bills, obviously we have to pay our bills and our obligation. I'm flipping the switch on that and fully investing first and then paying my bills from equity. So when I say stop paying your bills, start making your equity do the work, that's exactly what I mean, because you maintain ownership, price appreciation, and dividends over time, just like any business structure operates. When you think about the 30-year trap, that's what I call this, the traditional 401k approach, it works. It absolutely works. So if you're young and you're investing over the long term, the stock market's going to grow, and that's how you're going to retire, and that's why we have 401ks. But it costs you your most valuable asset, in my opinion, which is time. So when you think about time, I was thinking about the cruise. I have a few older sisters. One of my older sisters, her name's Tanya. She went through a breast cancer battle not very long ago. Thank God she made it through that. She's doing well. Her spirits are good, but it was so good to see her and my family and my mom, who's getting much, much older, and my older sister Robin as well. Time moves so quick, and that time is so precious and such a valuable commodity. So in my system, I'm front loading that investment to shorten the time frame to get to freedom so I can spend more time with the people I love. Looking at the math below, if you make $100,000 a year and you're investing kind of the leftovers of that $100,000 or $833 a month in this example, let's say you're getting an 8% average return on your investment and you're waiting, 360 months, you're going to end up with $1.25 million over the course of time, which is what allows people to retire. It just takes their whole life to get there. So you spend decades in what I call the accumulation phase before you ever see a dime of cash flow or freedom. When you look at the Paycheck to portfolio system, that timeline collapses dramatically. So the same apples to apples type of comparison here, $100,000 a year of W-2 income. If you 100% deploy that into the Paycheck to portfolio system, I'm getting 15 to 20% blended yields. You can see my time-weighted return I just showed you in E-Trades much higher than that. These 15 to 20% blended yields are dividends as well. So from a conservative perspective, in a 10-year projection, I'm estimated to be at $2.4 million, whereas in the traditional system of investing those leftovers, which I just showed you, were the 10% rate, you're at $156,000 because it hasn't had enough time to basically compound for you at that point. So what we're doing in the Paycheck to portfolio system is we're taking all of our capital, we're fully deploying that capital, which allows you to experience the compounding curve in a compressed timeline or a timeline that's collapsed in your favor. So you're not having to work 30 years. It's more of a 5 to 10-year range that allows you to basically be free from corporate America, your job. And quite frankly, it's a global problem with inflation. It's like swimming up current, essentially, and we're all fighting that battle. So we're taking a tried and true method of investing in the market. We're compressing that timeline by being fully invested, creating equity growth and cash flow. So if you look at 3 lanes, they all use similar playbooks. And sometimes I actually cross playbooks because I have multiple businesses. If you think about real estate, the asset is the property, the leverage is the mortgage, and the revenue is the rent. The overhead is tenants, repairs, taxes, often referred to as toilets and tenants. is some of the downside of real estate. I actually have a wholesale real estate business. So what I do is I'll get control of the contract of a property that has a higher value once it's fixed up. I will sell that off to other investors, and then I take that revenue and I put it in the Paycheck to Portfolio system. So I use real estate income as a feeder into the Paycheck to Portfolio system personally. On the business side, when you think about a company, you have the asset is the company, the leverage is an SBA loan or investors and private equity. The revenue is the profit from the operations. The overhead is the payroll, the inventory, HR, all the expenses that go along with managing a business. And if it's brick and mortar, obviously you're paying rent and different things like that. And then in the Paycheck to Portfolio system, the assets are the growth stocks that I invest into, the closed end funds, and the high yield funds that pay dividends. The leverage is the margin loan, and the revenue is cash flow and equity. I still own all of the equity. So, when I get paid $5,000 every 2 weeks, in the traditional sense, you would go and you would buy groceries, you would pay your mortgage, and then you would invest what was left over. Instead, I'm fully investing that $5,000 into equities and assets, borrowing to pay those bills. So my gross value is constantly growing with each capital infusion. And so I still have ownership in something versus that being consumed to zero. And then I'm getting the cash flow that's generated from that as well. The overhead is margin interest costs, which we'll talk about, and then put insurance to insure the portfolio against a market correction or market crash. I have videos on my channel called the Market Crash Cheat Code, how I protect my portfolio against a market correction or a market crash. You can check those out and how I manage that. So the business spread, just from a dividend perspective, I'm getting 15 to 20% yields just from the dividends. The overhead on margin can range from 5 to 10% typically right now. My margin interest rate is 5.49%. So just cash flow wise, you're generating between 5 and 15% of cash on your own money that would have been consumed otherwise in the Paycheck to Portfolio system. All of these use the same type of structure, just managed differently. And in my opinion, stocks are much easier because I can push a button, I can buy, I can push a button, I can sell, I can borrow from it with a debit card. There's no loan process or anything like that. Obviously, no brick or mortar to manage or tenants or other things. If you look at what I call my balance sheet view, I've spent most of my career in executive positions in healthcare. I ran private equity for quite some time as a regional vice president. So I'm very used to looking at balance sheets. It's where I'm very comfortable. I realize not everybody's used to looking at balance sheets, so I try to present it in a way that hopefully is easy for you to understand. So as of this morning, my gross portfolio value is $443,869. That's how much assets I've accumulated since I started to fully live out of my brokerage account. In the past, this would have been consumed and I would have just had leftovers. My net portfolio value after the margin I've used to live off of is $205,861. Just from a pure equity standpoint and capital gain standpoint, my portfolio has grown roughly $50,000. And then when you add in dividends and total return, I'm up $126,713. For the month of May, at the very bottom, I brought in $4,146 of dividends, straight cash flow. My margin interest was $1,052. Therefore, I had a net positive cash flow of $3,094 simply by living out of my brokerage account, which is creating real cash flow for me. So I'm getting equity ownership in the form of my gross portfolio value. So when the market goes up 2%, it's going up 2% of $443,869. And then it's generating real dividends off of that as well in the form of cash flow. It just compounds so much faster when you have full ownership of your portfolio like a business. And then, when you think about living from leverage, oftentimes this is referred to as buy, borrow, die, and it is used by ultra wealthy people. I'm going to talk about a few of them this morning. When you think about Elon Musk, He borrowed $12.5 billion against his shares in Tesla to fund $44 billion worth of an acquisition of Twitter. Basically, what he did there is he avoided a taxable event. He could have sold $12.5 billion of his Tesla shares and acquired that, but obviously that would trigger taxes and other things. So he simply leveraged. When you think about Larry Ellison and his Oracle shares, he pledges hundreds of millions in stock as collateral for personal loans to fund his lifestyle. Again, the reason that's done is because they maintain ownership and there's no taxable event from borrowing money. Debt is not taxed, and rich people know that. The Waltons, the asset is their Walmart shares. The way that they use that is the same exact way they use securities-backed lending at 1 to 3% rates to access cash while their massive portfolios continue to compound, again, avoiding taxes. So when you think about ultra-wealthy people, they're using the paycheck to portfolio system, but on a massive, massive scale. And that's how people live off of leverage, very wealthy people. So talking about the system in detail, when my deposit comes in, I route 100% of my W-2 income directly into my brokerage account. I buy assets that produce equity ownership and growth and dividends. So I invest in the three buckets: long-term growth stocks and ETFs that allow me my equity base, close-end funds such as Cornerstone that drip at the net asset value every month that grow the equity base, and then high-yield funds that come in and erode away my living expenses in a good way, and then also pay my margin interest expenses, which will set me free from my 9 to 5 job. The bridge, so what my dividends don't cover, I use margin to pay my bills until my dividends grow enough to cover my expenses, which flip that. I'm going to show that to you in the Fire Model Pro calculator here in just a second. But my goal is really to never have to sell a share of stock. It's simply to borrow from that equity to pay my bills and to live off of. And over time, the snowball will accumulate and my dividends will exceed my expenses at that point. So the loop closes, it just continues on and on. The dividends generated in step 2 automatically pay down the margin, which increases your equity, and you just keep going, and so does your W-2 income. So every week I put out a community survey, and I always try to answer those questions that kind of catch my eye every week so I can help you live the paycheck to portfolio system in your personal life. You can see a few of the questions I have I'm going to go through here. One of the comments here says, I've only started my portfolio a few weeks ago. I can't wait for the day it pays out what I'm making at my job. Exactly. That's what will set you free. So I responded here basically saying that's exactly why I built the system. I'm in the same boat as you are. Most people focus on replacing their paycheck overnight, but it happens one layer at a time. You build assets, produce cash flow, cover expenses. The goal isn't to quit your job next month. The goal is to consistently turn earned income into ownership until your portfolio does the heavy lifting with equity growth and time. You can see the next question here, and I'm going to show this in the Fire Model Pro calculator here at the end, just so you can see this hawk, because I know you've been talking about this in the Discord. But what are some strategies for managing equity? If it gets too low, should I stop buying an asset for a bit? So, what I would say is it's just like you would manage your checking account in the old days. You have to budget your money. You have to watch your balance. And it's the same thing. You're just doing that from an equity perspective now. But equity is the barometer of the entire system. If it gets too low, personally, I don't panic, but I pay attention to it. It's a flag for me. So new money naturally pays down margin, which increases your equity, and I may become more selective or focus on lower margin maintenance positions. The biggest mistake is stopping altogether, right? Every invested paycheck reduces margin and rebuilds equity. Then when your dividends hit, it reduces margin, increases your equity. What I would do personally if it was me is I would check to make sure my spending is under control, that my budget's intact. I would be looking at lower margin maintenance positions, 30% margin maintenance positions versus 100% margin maintenance positions. And I would be scaling back for a month if I had to accumulate equity. But You would manage it the exact same way you would manage it in your checking account, right? If you have $1,000 left for the month and you don't get paid until the next month, you're going to have to manage that $1,000 within that month time frame. It really is no different. You're just looking at it from an equity perspective, and your dollar goes farther with equity due to margin maintenance requirements, right? If you invest $1,000 into a 30% margin maintenance name, they're only going to lock up $300 of your equity, the brokerage that is. So your dollar actually goes further living from equity than it does from dollar to dollar checking account perspectives. The last question here said, do you ever have to quick pay anyone? How do you go about it? And I said all the time, I typically use the Cash App or Zelle linked directly to my E-Trade debit card. If I need to pay someone quickly, the funds come directly from the brokerage ecosystem. So it's linked directly to my E-Trade debit card, which is accessed through the Cash App, which is what I use most of the time. And it immediately just gets pulled from my equity base here. Let's look at the Fire Model Pro Calculator, and then I'll talk about some resources. Okay, this is the Fire Model Pro Calculator under the Tools tab in the Paycheck to Portfolio Training Academy. Basically, what this does is it shows you your Fire crossover. It's pulling live data from my brokerage account. You can see right now the drip yield I'm getting is about 4.5% on 23 holdings. My non-drip or high yield dividends is giving me about 20.4%. Right now, when my paycheck comes in every 2 weeks, I plan on splitting it 50-50. What do I mean by that? 50% I aim for growth and closed-end funds, and 50% I aim for high yield funds. So that's what the scenario input show down here. So basically under the advanced tab here, you can see right now I invest $132,000 a year of my income. My annual living expenses are about $100,000 a year. My starting margin debt when I last updated this was right around 235,000. My drip allocation is that 50-50 split I was just talking about. You can enter your inflation rates here. This is completely adjustable. I have 4% inflation entered. My margin interest rate's 5.49%. I have a 17% capital appreciation here, which I think is conservative based off of my history that I showed you on the E-Trade tab up here. The projected timeline is 60 months. The drip at NAV discount for Cornerstone right now is 15%. So it's taking all of those things into account. And what it does is it gives you your starting portfolio value here. This is both of the Spark to Fire account and my large portfolio that it's showing on this calculation, just to give you an idea. So it's saying that right now between those two accounts, there's $451,000 of gross portfolio value. In 5 years with full deployment, it should be $1.6 million, or basically 4 times growth. The drip dividends reinvested will be 113,000. The cash dividends will be 508. The peak margin between both accounts will be 376,000, and the final equity will be 78%. And you're seeing that on the growth trajectory below, with the blue line being the gross value, green line net value. The dotted purple line is actually your own W-2 contributions that would have been spent otherwise. And then the green vertical line is your Fire crossover, to where basically your dividends cover all of your expenses. It breaks this down for you in multiple charts, which you can hover over, and it will show you your projections there all along the way. But what I want to show you is the actual monthly projection data, which is so important, okay? So right now, when you take into account my accounts together, in month one, we're projected to be at $462,535 of gross value. I'll have about $872 of dividends that are dripped and reinvested. I'm going to have $3,919 projected right now with dividend yields, which ebb and flow like we talked about under the estimated income tab. Sometimes it's 4,400, sometimes it's 4,800. Right now, the projection is 3,919. So this is dynamic. It grabs your real-time data and updates this. I'm projected to have to pay out about $1,075 in interest. Therefore, after that, I'm going to have $2,844 of cash after interest, which automatically reduces my expenses of $8,333 a month. I'm going to use $5,489 of margin to pay those bills, which will accumulate my margin debt over here. My W-2 income will come in right here, and my net value is right here, and my equity is projected to be at 48%. My hard threshold is 50%. I have a wholesale real estate deal that's going through right now, so I have wired money that's out, but I expect much more money coming in, which will put me right above, again, probably 51 or 52% when that money comes back into the system. So I've been doing this long enough to where I can manage, 48, 49% equity, but I know that I'm getting money coming back in the next week to 10 days, which is going to put me at about 51% equity. So if you're new to the Paycheck to Portfolio system, please watch the Spark to Fire account where I started that for my 18-year-old daughter and scaling into the system and what that looks like. So every month it's showing you basically how your equity trend should outline for you. And then it's going to highlight right here your crossover point. And what that's telling you is now that your non-drip dividends are exceeding your monthly living expenses, the margin paid flips right here and starts to pay down the margin balance. Now, the truth is I'm never going to stop using margin because I can leverage it and I can borrow from it at a cheaper rate than I can invest in return on it. So I will never pay margin completely off. But you can see at the end of 5 years, I'm projected to be at $1.6 million of gross portfolio value and $1.3 million of net portfolio value, which is where the freedom comes from in the Paycheck to Portfolio system, and 78% equity at that point. Let's go back into the slide deck. All of my resources are available under all of the pinned comments and all of my videos. I have a couple free resources for you. You can download the free starter kit and simple calculator if you want to see how your own finances might be impacted and how the system works. There's a free calculator here that shows you your 5-year projection on the Training Academy. And then we have some premium access as well. You can join the Paycheck to Portfolio membership. That gets you access to the private Discord community, all living out of our brokerage accounts. You get access to the full Training Academy, which is step-by-step training, and the tools I was just showing on the Fire Model Pro. And then we have the full Paycheck to Portfolio web application, which interfaces directly with your brokerage and does all of the business analytics for you and shows you real-time movement and equity. You can book a one-on-one strategy call with me. That's a high-level 30-minute call. And you can set up white glove coaching with me if you would like, which allows you lifetime Discord access, lifetime Academy access. You get 6 months free of the full web app, and then you get one-on-one mentorship with me. I hope you found this video useful. Please like and subscribe, and we'll talk to you Wednesday for our next video. Hope you have a great rest of your weekend.